Good afternoon, everybody, and welcome back to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, and joined today not by my colleague Todd Anderson, who had a flight delay and ended up not being able to do the news show today. So Kevin Travers, our intrepid reporter, has stepped in. Thank you, Trevor. How are you?
Great to be here.
All right, thanks for the last minute for jumping in again. So, and we have Tim Lee as our special guest today. How are you doing, Tim?
Hello, Peter. Great to be here. My fifth appearance.
Fifth appearance. All right, good.
I think so. Yeah, thank you.
So, give us a 30-second 30-second sort of summary of what you've been up to the last few months.
Sure. Last time we got together, I was heads down raising money. You know, this was back in I guess March, February-ish. And we, as some of you guys have seen, we got acquired by an awesome company called Business Warrior. It's actually a publicly traded company here in the U.S. They're traded on OTC. BZWR is the ticker. Check it out. And it was a fantastic marriage. They built a lot of small business facing software, and to a certain extent, the Alchemies are doing the same thing. Right. And we actually met as a client and a partner kind of a relationship. So we know them for a whole year. They kind of like what we did. Long story short, the marriage happened. We got acquired by Business Warrior, and now we're working for Business Warrior under the Alchemy brand. So,
well, congratulations on that.
Thank you very much.
So let's get into it. We got a lot of news to cover. The biggest story of the week, and finally, I'm thinking we've been talking about Celsius on the news show now for about 6 weeks straight, every single week. I'm hoping this sort of at least wraps up a chapter, as the Wall Street Journal reported. Actually, everyone reported late yesterday that they have declared, or they filed for Chapter 11 bankruptcy protection. We suspected this was coming. We have others in this space. The crypto lending space hasn't been a good space to be in if you don't have extremely strong risk management, and I think most people would agree that Celsius didn't. Anyway, they have some money on hand. They had 1.7 million customers as of June. Now those customers are now going to be unsecured creditors, and we'll see what happens there. So the story will continue, but it's really it's sort of, I guess, the end of sort of this unknown chapter, and now we're going into the bankruptcy phase.
Yeah, super unfortunate. There are $167 million cash on hand to Celsius. I guess 1.7 million customers. I wonder what the demographics of the customers are, and maybe Kevin can dive into it in a little bit. Risk management, even in a fiat environment, predicting credit loss and all that stuff is hard enough, let alone the entire crypto market. You look at every single coin out there is 40-50% off. It's just unfortunate that everybody caught this cold. It's good when it's good. It's bad right now. Everything's horrible. So absolutely. I hope some of those 1.7 million people get a little bit of cash out of this thing.
Yes.
Kevin?
It's truly unimaginable when the underlying that you're lending out goes down, then the whole thing falls like a house of cards. And it's sad to see. One of the last public appearances the CEO made was at one of our events, and I was getting whipped up into his investor fury because he was saying the future of banking, the future of investing is doing what investment banks do, but giving you the profits. And it sounded great. So I can see, I don't know, but your entire life savings and people my age and older and people that don't trust banks, all taken away over just bad bets dealing within the same industry because there's nowhere else to put the capital, it feels like.
Yeah, in a span of 40 days or something like that, 35, 40 days is horrible.
Well, yeah, I mean, this happened like Kevin, you were, I think, in the room when he spoke, right?
I was supposed to talk to him, and 3 days before they turned off withdrawals. Yeah. And then I reached out to my contact who was fired, and their email was deleted, and they cut back in their own company.
Yeah, so it's really. He was a great speaker, Alex Majitsky, and that's why we've had him speak many times. And the company seemed to be doing well, and they were doing well while crypto was going up. But clearly, some of the stories we've heard about over the last few weeks, giving sort of unsecured loans out to people that with no collateral and large tens of millions in some cases, and Just crazy. There'll be books written about this. There'll be a movie about this, I think, at some point. It's such an amazing
like The
story.
Big Short. It's like the 2008
Right.
lending money
That's right.
on bad money, but it's confined to crypto.
Yeah. Anyway, moving on. We're gonna have a lot of bad news today. It's just the way it's going to be. So Stripe. This is breaking news that came out late this morning. Stripe, basically, someone figured out that they have an internal email that went out last week that basically they updated their 409A valuation, which is a sort of an internal valuation. Often you're using it to price options for employees and that sort of thing. They've gone and that's dropped. So that was at $40 a share. Now it's $29 a share. That's a 28% cut. Now, this is not, they haven't gone out to the public market. So I haven't gone out to the private markets and tried to raise money or anything. So we don't know if this is necessarily what the private markets would value them at, but it's 74 billion now, down from like, I think it was 95 last year. So Stripe is not immune to the pullback in valuations, it seems.
Yeah, they're so ingrained in our day-to-day sort of payments activities. If you look at Target, Amazon, Costco, even everybody's taking a 20-30% haircut, and that was a couple of months ago, right? Things had not really gone well for the past 20-30 days. I'm not surprised they're taking a 28% haircut. I'm thinking that there might be some layoffs here and there, but they're just so plugged into everything we do. When Amazon catches a cold, Stripe will feel it. That's the bottom line, Kevin.
Yeah, it's they're one of the grandfathers of crypto, or not crypto, fintech. And I guess I should have expected that they are going to lower in valuation just like the rest. But still, when a big name like them shows that haircut, it's scary. Being or writing or covering the space or being involved in the space.
Yeah. I wonder what the next step is. I mean, I feel like they don't need to raise any more money, but this has to be a precursor to something,
Yeah, it's possible. I mean, I'd be surprised if there's no layoffs because, I mean, Stripe has they've got a great business where, I mean, everyone uses Stripe, it seems. And, but when economic activity goes down, and we've seen that, that like the Amazon Prime Day wasn't as big as they hoped. And
that's right.
There's just less activity happening, and we're talking about we might even be in a recession right now. So they're going to get hit. Their revenue, I'm sure, is not going to increase like it has been pretty much forever. Right. So anyway, talking about drops in valuation, I'm sure Klarna would love to have had a 28% cut in their valuation. Their valuation was an 85% cut. And we find this is another story that's been going on for weeks, and finally came to an end where they announced the closing of their latest round. $800 million they raised. I think the last round they did was $1 billion. So they are still able to raise lots of money, and they're growing like gangbusters. But the valuation is now 6.7 billion. Of course, they had a slide and they showed of a comparison compared to December of 31, 2018. They have gone up 219%. So good for them. But like you got they have a public market comp with a firm. Afterpay no longer is a comp because now it looks like a good deal for them. Afterpay sort of sold at 28 billion last year, looking good for the Afterpay founders. They got block shares for that, but still, Klarna not a good morale. Can't be good inside that company right now.
Yeah, the other one that was super dramatic was Zip and Sezzle, right?
Yeah,
that merger was just insane. Everything went to a penny. I mean, the companies are essentially worthless.
Right.
I don't know what
the merger's off, of course. So.
The merger's off, right? There's nothing to merge. There's nothing left to merge, I suppose. But this is scary. I mean, buy now, pay later was going to be the latest version of fintech, where no interest up front. Maybe there's a little bit for longer term loans, and customers are happy. All I've seen so far is maybe the credit market. I mean, the charge-off rate's a little bit higher than expected. Maybe the merchants are over their heads about how much credit they want to extend on their behalf. But 85% correction on the valuation, Klarna, the number one guy out there, that's scary. Kevin, what?
Yeah, I mean, and even if they took the chance to go public or sell when they could have at the height like a year ago, the other companies are all down in valuation too. When all Apple or Google or all a competitor has to do, like a massive one like Apple or Google, is just say, "Oh, we added Pay in 4 to our wallet." That's not a good. What can you do to compete with that at all besides sales and trying to work with merchants? I guess.
Yeah, you're right. You're right. All these guys are going down market directly to the retailers, and all the retailers become BNPL guys. So the Klarna and Zips and the Sells of the world are to feel like they're the 2.0 now, right? The 3.0 is actually just having the retailers become BNPL players themselves.
Right. And Apple is obviously going to become a massive player in BNPL. Although, when you think about it, like consumers love BNPL, so this is here to stay, and it's going to become a bigger and bigger industry. And it's say like credit cards, the average credit card total outstanding is somewhere around $1 trillion. It's usually a little under these days.
That's right.
So say the buy now pay later gets to 500 billion, which is not, that's probably not that far fetched. There's enough room for lots of players at that volume.
Yeah.
So
yeah.
Apple can end up with 25% of the market, and you can still have Afterpay and everybody else have healthy businesses.
Exactly. Yeah. Yet to be seen there.
Anyway, so the next story I want to talk about, this was 3 Arrows Capital. We've talked about them here before. There'll be books written about this company as well, because they made incredible bets. Sometimes they did, they would leverage the money they had and buy, NFTs, lend it out, and really just super risky stuff. And they imploded. Now, the company founders have gone AWOL. We don't know where they are. I think there was a couple of tweets, but no one knows where they actually are. At the start of this year, they had like $10 billion in assets, 3 Arrows Capital. Now they're done. And New York judge has frozen the assets, whatever they have left of the company. And it's just a crazy, crazy story when you see some of the moves these people made. I mean, like, it just goes to show that there's a lot of smart people in crypto, and also a lot of people that, if you were working for a traditional bank and you saw some of the risk management practices at 3 Arrows Capital, you would have just been like, "Oh my God, this is insane."
Yeah. This feels like 2006 and 2007 trading derivatives again, right? All of these things are assets. Everybody's betting on top of everybody else, and it's not going to end well. It has to crash,
right?
Like this. But yeah, I don't know what else is left in the in their assets, right? Probably just a bunch of
who knows what they're actually freezing, but it's nowhere near 10 billion, that's for sure.
Chairs or tables, probably what's left.
They went to their Singapore offices, and there was like 2 monitors left, and everyone else they'd gone. They're somewhere where hopefully the U.S. doesn't extradite to the U.S. It's like the crypto markets are supposed to be like a revolution, not like old banking, but we're seeing the same mistakes that they made before I was even in high school. The same self-betting, self-dealing, then running when everything starts crashing.
Yeah.
It goes from people who are betting with more getting in over their heads to suddenly being on the FBI most wanted list.
The unregulated markets are, I don't know. I think we have a piece about regulation, but this if this doesn't call for regulation, I don't know what will be for investors.
And it just makes the whole industry look like a bunch of cowboys, really, and that's not a good look. Anyway, moving on. But this is actually not a bad news story. We're going to talk about Plaid. Plaid announced today support for thousands of crypto exchanges. So you can connect your bank account with Plaid. Super useful. You can connect to your wealth management accounts as well, all through Plaid. But you couldn't connect your crypto, and that's been annoying. I mean, I keep my stuff in a spreadsheet, partly because of this. And anyway, that's going to change. They says driven by customer demand, they are now basically connecting to. They're already live with Gemini, Kraken, Binance US, and there's more to come. They're going to be really. I said thousands of crypto exchanges are going to be able to be connected through Plaid now. So that's good news for the crypto industry, right?
Yeah, that's great. I mean, like, your crypto wallet, crypto holdings is no different than your fiat holdings, right? So if people want to underwrite people with whatever they own, crypto, fiat, asset classes of, whatever real estate, income, right? That's what, or the cash flow, that's what Plaid does really well. I think that makes perfect sense. Any fintech startups want to lend against people's crypto holdings, not like Three Arrows or anything, anybody else we mentioned. This is great. I think it's a great move for Plaid.
I definitely think it's wonderful. It's funny how I use Plaid. We all have to use Plaid, obviously, but I'm nervous of the open banking concept only because they have all my data and I signed it away just so I can log into an app. But when it comes to crypto, we're all used to that. You can just look up my like MetaMask addresses and stuff. You'll see every transaction I ever did. That's sort of a weird privacy open native thing to crypto that it makes makes the ecosystem very interesting. I think it's a great move, and it's sort of about time.
Yeah.
Yeah.
And
This is definitely built for the other side of the equation. The
I think,
older FinTech 1.0 guys want to peer into what's going on in this space.
Right. And so, like I said, it was driven by the wealth management and financial planning
That's right.
space because a lot of these places, everyone's connected into the big guys, and you get your crypto holdings, and you can't. And there's going to be plenty of these wealth managers now who are trying to manage assets for people who've got wealthy in crypto. So that's probably what's behind it. So anyway, let's go back to bad news again. We have this again. This just came out a couple of hours ago. OpenSea laying off 20% of its staff. Now, the NFT market, was so hot in 2021. The popular piece Kevin has ever written was about how to mint an NFT, and that was done, I think, back last year, I think, wasn't it, Kevin? But anyway, NFTs were so hot, and now they're not. And so they say the interesting thing about this is the CEO said that with this layoff, they can weather 5 years of this sort of low market conditions, like the current volume that OpenSea is seeing right now. They can weather 5 years of that, which I thought is that's a pretty good runway, I would say.
Have they been around for 5 years? I'm just kidding.
I don't think they have.
Yeah, and I wonder what 20% means. Is it 6 people or 60 people? I couldn't get my hands on his tweet.
Yeah, you don't know. I mean, I think it's more than 6. It's probably might be more than 60.
I've heard them tout it as like an overhead light, decentralized new age company, but apparently, according to their LinkedIn, there's 740 people that have claimed their employees of them. So that's like 100. Yeah. That's almost 150 people, right? Based in Soho and San Fran and other places. So that's scary. I know. So they would tout it as like equity light, overhead light, but they make money on interchange from NFT sales, and they're down 40% or 20% here and there. And they only offer Polygon layer 2 of Ethereum and Ethereum. And there's other alternatives. There's other platforms that aren't really used as much, but still there's other platforms. They were the only player when I was writing up that article in like October. They were really the only place you could go. And now there's just not.
Last time I went on to OpenSea, I was looking at some of the real estate properties in Metaverse. I thought that was going to just catapult them to the next level. What do you think, Kevin? What happened there? Didn't get the traction they wanted.
It didn't get the traction. It didn't get the use case. I think there's a big runway in future for NFTs in every sort, from music to ownership to properties in real world, or I guess in Metaverse. But there was also a lot of Americans and people flush with cash, and a lot of institutions flush with new hires in a tech virtual only COVID world landscape. And that definitely also with cryptocurrency prices skyrocketing leads to a huge amount of growth. And you see it cycle after cycle. And it's funny that they say 5 years, because it tends to be 4-year cycles in the crypto space, at least so far, where there's huge bull runs, wild, crazy fanfare and noise, and then it all collapses down. But if they can survive, they can build something more in the future, because they were what Coinbase and GameStop and I guess even Reddit copied when they're like, we're going to launch our own NFT platforms.
Right.
That's right.
Yeah. Coinbase's one hasn't gotten much traction either. So they launched at a bad time, because they launched right as NFTs were tanking, it seems. So anyway, we're done with bad news. So the last third of the show is going to be good news. How about that? Or neutral news, shall we say? Yes. So let's get away from crypto. Let's get back to fintech. And this was Ron Shevlin's article that he does his weekly column in Forbes, talking. They did a new study at Cornerstone, which is the company. Cornerstone Advisors is his company. They do research studies regularly, talking about non-finance companies and their potential opportunity for offering financial products. Now, we've seen it a little bit so far, like T-Mobile have checking accounts through Bank Mobile or BMTC or whatever they're called now. But this is they basically surveyed people saying, would you want to open, would you want to get a home equity loan from Home Depot? Would you want to have a payment mechanism with PlayStation? And so they've got these, and the answer is yes. Like huge numbers of these users want to be offered financial products. There's a lot of loyalty, and I mean some of the numbers that they threw around in this article. I mean, these are not just little sideline businesses. This can be,
That's right.
I mean, potentially massive business. I know you've been on the bandwagon for a while, Tim, on this sort of embedded finance piece.
Yes, I read this thing back and forth a couple of times. Ron, thank you for writing this article. I love this space. The 1.0, 2.0 guys in the point of sale financing, buy now pay later space are Affirms of the world. That's a big juggernaut, right? We talked about some of those before. I think it is absolutely time for retailers to do this themselves, right? The technology is there.
Yep.
They have the balance sheet to do it. Why not? So this trend is going to be the future. I don't know how a firm is going to react to this. Apple came up with their own, right? I thought Apple's going to do BNPL for everybody else, but Apple is one of the poster childs on this movement, right? The retailers
really
themselves are taking payment plans. Okay.
Well, absolutely. I think Ron and his research that they do at Cornerstone Advisors are always spot on. 2 days after this article released, PlayStation announced a loyalty rewards program for their players. That's going to have loyalty points to be used as currency in their own ecosystem, as well as like their own wallet and everything. It is completely on the spot, and I know that I spend more at Amazon because of their card that they gave me.
Yeah,
like I definitely do. So, and I understand like that even in my own, I guess, lifestyle.
Are you a PlayStation guy, Kevin, or are you
Xbox?
Xbox,
but
Xbox.
Also PC stuff. But man, that's talk about nerdy.
Yeah, no, I didn't know that. That's interesting. Okay, so actually moving on to a funding round. There's lots of funding rounds every week, and we don't very often highlight them unless they're big. But wanted to highlight this company because I really like what they're doing. Quadrata. You wrote about this, Kevin. $7.5 million funding round from Dragonfly Capital, and that's the thing. There are still good companies raising money, and because there's lots of dry powder out there in the VC world. So I just really like. Why don't you talk about what you wrote the article, Kevin, this week? So tell us a little bit about it.
Yeah, so Quadrata is a Web3 passport startup. They're trying to make a Web3 way to, or Web3 native way to make sure you are who you say you are when you're interacting with Web3 apps or crypto lending products or anything. Because one of the biggest problems, and it's refreshing to see them get their seed funding round, especially from Dragonfly. I talked to them before when they first split off from Spring Labs and in relation to TransUnion. But they're pushing towards this world that we need. They're trying to balance the Web3, the DeFi anonymity, like pull and self-sovereignty with, we need to know who's who if we're going to be giving up money, if we're going to be lending, if we're going to be transacting. And they're trying to do it in an anonymized way where it sits in your account, your MetaMask, it's tied to your name, basically, whether you made loans in the past year or whether you're really say you are. I think it's a fine line and it's a difficult project to work on, but it's completely necessary. You talk to people in Web3, you talk to people that run exchanges, they're not worried about rug pulling and they're not there to steal your money if they're really serious. They're worried about people coming in and leveraging coins and then bringing it to their exchange, and they're sort of stuck holding the bag when things fall apart. Like we've just seen it happen in DeFi. So I love what they're trying to do, and I'm excited to see their products as they roll out.
Yeah, this is the next stage of identity verification, in my opinion. The portability of your identity, you can take everywhere as an extension on the browser. That's going to change the world. No longer would a centralized bureau or identity bureau say, hey, this is the sole version of your identity, right? People can take it with them everywhere they go. I think it's actually great. And Spring Labs guys came out of Innova Financial, right, back in the days.
Yeah, Innova and then Avant. Yeah,
Avant, that's right. Yeah,
they
good
know
people.
The consumer credit space really well, and
Yes.
that's the thing that I think. If I'm just really excited about this product, and I interviewed John Sun on our Crypto Winter interview podcast series that we just launched this week. And I interviewed him yesterday, and actually asked him point blank about when this product is going to be available. And said they hope to get something out in market by the end of the year. So, and this is really because you go to your MetaMask wallet and you go and you connect it to Aave or Compound or anything, and you go off, and it's all totally anonymous, and you got no idea whether this person is a good credit or not. And what they're talking about doing is saying, right, if you go through this process, this AML process, and this sort of, you can put your credit score on there. They're working with TransUnion. They've got a partnership with TransUnion for credit scoring and reputation. So, you can go around, in DeFi and potentially get better terms. If you've got better terms, if they know who you are and they know you've got a credit score of more than 720, for example.
That's right.
There's no reason why you shouldn't be getting better terms.
Right. And identity has been verified in multiple places continuously.
And if it just says that as a check mark and not any identifiers, then the exchange doesn't know who you are, but they know you were who you said you were when you talked to TransUnion. And the people at TransUnion who are so much more innovative than I thought when I got the chance to talk to them, I thought they'd be, I don't know, held back or something because they're legacy credit checking. But no, they're excited for eventually onboarding this as you can increase or build a credit score by using DeFi products somehow in the future.
That's right.
Yeah, no, TransUnion, they spoke at Fintech Nexus back in New York a few weeks back, and that I actually just went back and re-listened to that session because I was interviewing John yesterday, and I feel like cutting edge. If you got a chance, this is Frank Rotman interviewing John Sun and Liz from TransUnion, Liz Pagel from TransUnion. And it's only a 20-minute session, but boy, some really great stuff in there. I think the future of identity, the future of credit, it's all going to change. It's going to change slowly. I've come to think it's not going to be as fast as what I thought a month or a year or so ago, but it's going to happen anyway. Almost out of time. I want to get to the last story, and this is just another Forbes column that caught my eye this week, and basically saying, there's been a lot of talk about buy now, pay later, and regulatory challenges they may come against. And this column was saying, you know what? I actually don't think there's going to be a major impact or negative impact on BNPL with regulation. Even though, like CFPB, we covered this on the news show when it happened back in December, open up an inquiry into BNPL. But, there's a lot of people who say they don't think there's going to be any specific BNPL regulation. And
the only thing I got out of this is that it's disclosure. I mean, BNPL players don't really charge a whole lot of interest rates, right? Maybe there's longer term products that has a low interest bearing product, but it's NSF fees, overdraft fees. Hey, you draw payment, you didn't tell the customer, all those interest free, all good and all, but there's $25 NSF fee. So I think some of that stuff, it needs to be just disclosed to people, to the consumers. But I think BNPL product at its core is a great product. No interest, pay over time. In today's inflationary market, you got to stretch your wallet a little bit, right? Pay it over 12 days, but letting the customer know, hey, here's what you're really getting into when we draw that payment from your checking account. If you don't have money, there might be a $25 fee. Just disclose up front as much as possible. Okay.
Yeah, absolutely. I think this article, you were totally right. It talked a ton about disclosure and about buy now, pay later products that are buy now, pay later in name only, but still function more like an old-fashioned credit product. And I think that the only way to get rid of that is by building specific regulation for buy now, pay later. But as the article sort of pointed out, it would be really difficult because right now, if you report it for a credit score, say for FICO, it would count as like a $200 prepaid credit card. So paying that off and then closing that card would destroy your credit, especially if you did it 4 times a year, as some people do with buy now, pay later. But it showed the need for new regulatory, oversight as a way to help industry. And we're seeing this more and more, especially with the industry getting haircut after haircut as we're watching.
Yeah, I mean,
Yeah.
I think all the three major credit bureaus are committed to doing something for buy now, pay later. I know that
That's right.
we've done webinars with Experian about this, and it's going that's the thing that's going to change. And I think, because a lot of buy now, pay later. I mean, a lot of people pay it on time and they get no reward for it, and that's going to change.
Right.
Anyway, we are out of time. Before we go, though, just one little plug, if I may. We have Dealmakers West. This is our boutique in-person event happening at Laguna Beach.
Down the street from here.
Yep, there you go. The Ritz Carlton at Laguna Beach. It's going to be a fantastic event. We still have tickets available. Lend.com. I keep making mistakes on that. FintechNexus.com. Find out. Come join us. Anyway, we'll be back actually next week. We will not be on because I'm going to be in London and Todd is on vacation. So we are going to skip a week. We'll be back in 2 weeks. Have a great time, everybody. We'll see you back here then. Thanks,
Awesome.
everybody.
Thank you, Peter. Thank you, Kevin.